trades go off, where it looks essentially like a gap on the 1 minute chart of the put call ratio, just a basic, biggest version of the CBOE put call ratio. I think you're seeing a lot of big options bets, or maybe big options hedges that are taken in big chunks, and they're probably institutional moves, and it's probably this process of a slower mover. I think that probably the smaller traders have been a little more nimble on this one, but it still means that you've got kind of a glacier built up now of money that could melt if the world changes in certain ways. But that's one of the biggest tricks of this particular environment. I don't think that in my career of 20 plus years, and yours as well, I don't think we've ever seen a situation where it's so clearly about a small handful of people and the types of decisions they end up making that are going to define kind of the path forward to some extent. Normally, I would like to say that it's where the positioning vulnerability is, and I still think that's the accelerant. But the directional catalyst is probably not going to be pinned just to positioning at this point, because we have a real kind of tipping point here as far as whether or not we actually are going to dismantle a structure of global trade that's been in place for decades, and that really is a necessary ingredient in the continuation of this cycle.
Right.
So I think that people are really kind of bracing against the possibility that that whole structure unravels. And now with the antitrust stuff, that the other structure that's part of it, which is allowing the sort of mega cap tech monopolies, is part of the narrative of this cycle. And you've got, free movement of trade and, really kind of allowing for, technology sector mega cap monopoly kind of structures to develop. That's been an investment narrative that's defined this cycle, the two things together, and they're both possibly being dismantled. And if so, I think that institutional research firms would say probably to their most important clients that the cycle can't survive that. And so we're seeing the bracing for that.
Yeah, and I mean, obviously we're seeing that with Google and Facebook today. Apple as well was another one that I believe that there was a DOJ hearing being laid out. So, certainly breaking up those tech mega giants, and it'll open up opportunity. But in order for us to get there, there's going to be a little bit of pain as we wait for where to see that money flows. Brett, what would let me ask you two quick scenarios. What would you expect to see in the tape if we saw Robo catch up to Lobo, and also the opposite, if perhaps the Lobo people were just getting caught a little bit too offsides with overly aggressive hedging? What would you see? What would you be looking for in those two scenarios?
Okay, so let's look at the second one first, because this actually brings up one of the most important parts of bear market trading. And probably a lot of people who are listening to this have no experience with bear market trading. And so that's where you need to listen to Gavin and I, because we have been active market participants through two bear markets, and it's an entirely different kind of trading. And so one of the core components, and I'm not saying this is necessarily bear market, I'm just saying here's what to watch for. The second scenario that he mentioned is you get to an extreme of bearishness in something that's an important contrarian indicator, like the Lobo ratio, the large only buy to open put call ratio among larger traders. You get to a situation where you've got a bearish consensus and an indicator like that, and then let's say it just kind of dissolves back into the middle as the market traces sideways. That's a typical thing to look for that tells you, oh, we might be in a bear market. Those sorts of things tend to happen with sentiment indicators in a bear market. You get to extremes, and then maybe there's a little squeeze in there, but it's something that happens to just kind of shake off the bearish extreme, and you get back to neutral readings on everything, and then you start to roll back over and hit supports again, and then you go through them hard. And that kind of mentality will repeat itself again and again if this is going to be a continued downward trend. So the other scenario, the first scenario, which is, let's say Robo, the retail-only buy-to-open put-call ratio, spikes up into extreme aversion territory, extreme risk aversion territory, where people are buying lots of puts and no calls. That would be the type of thing, if Lobo's still sitting there and Robo moves like that, that's the type of thing you buy. You find a way to get yourself in the market when you see both of those ratios pointing in that direction. Now, as I said a few minutes ago,
the idea there, Brett, being that these institutional investors will view the Robo risk protection as being late to the party and take advantage of some cheaper pricing?
I don't know if there's that kind of recursive awareness, but it just like you've got everybody lined up
Yeah.
across the board now on the same side of things, and it's a lean. Everybody's leaning so hard. I mean, probably that would be, in reaction to things seemingly deteriorating further. And it's possible that we could start to at least click back to opening a door to feeling like, hey, the previous world could possibly come back into existence, or at least in the kind of common knowledge game that other people might believe it could. And if you have everybody leaning that hard toward protection, toward puts, then you're really opening up kind of a clear right of way back to the upside in a way that's worth taking a bet on, even if you don't know what's going to happen in the world. But like I was saying a few minutes ago, one of the real tricky problems with this particular environment is it does seem possibly more than I've ever experienced in my career as being something that truly is driven by the types of policy decisions being made by just a handful of people, and that is literally an unanalyzable situation.
Right, because it's like you said, and we'll break into this a little bit more with why the Mexican tweet was so important. When there's the unpredictability around a handful of people, it just makes it difficult for longer term planning on the business side to really take things into consideration. And Brett and I are going to break into that in a little bit more depth here shortly. But Brett, let's take a look at some of the other extreme readings that we're catching in the sentiment, because a number of them had jumped in on the pessimistic side. The U.S. dollar, I think we could we've seen that unfold, and I don't think that there's much of a story there. But one that I know you were looking at, I know there was two new ones that, not new, but two that had kind of jumped up on your radar. The first one being that risk appetite one, which for a second week in a row was down. And do you want to explain to people what the risk appetite indicator is and why that's so important?
Yeah, sure. I mean, this is essentially an aggregation of a couple of different uh, big Wall Street firm risk indexes, and they're looking at a lot of different factors, but most of them are market factors, and it's the kind of indicator that I normally like to stay away from a little bit, but since this is an aggregate of them, then it kind of feeds back into itself a little bit in the analysis. In other words, if you see this would reasonably allow you to say, if you see this at an extreme, this would reasonably allow you to say that everybody who's looking at market-based indicators of sentiment is all going to be starting to draw the same conclusions.
And Brett, just to add on some of the things that this looks at, just to give people a heads up: credit spreads, it's looking at equity and foreign exchange volatility, gold prices, which we know, Brett, you're long gold right there, and then also sector relative performance. So taking a look at like defensives against growth sectors. So it's a pretty broad look at some of the different risk appetite, which we call it, instruments that are
Right.
out there.
And so it's like when we had our first episode of this show, I said I would guard against those types of indicators a little bit because there's an inference step in there, so it's not directly sentiment. And there's possibilities that could arise, though they may not be typical, where you could see markets act a certain way, but it doesn't necessarily reflect an underlying sentiment environment. But in this case, again, since it's an aggregation of several different versions of that kind of thing, when it gets to an extreme, I definitely take notice because, this is just as much a commentary on the sentiment around the economic cycle as it is around the market cycle. When you start looking at where credit spreads are going, you can see right now investment grade debt is holding up and high yield debt is starting to not hold up. And I think that the spread over the last few weeks, even though if you look at a high yield debt index of some kind, it doesn't look very bloody.
I'm pulling up the HYG right
It
now,
looks a
Brett.
little bit
That's
like the
good read.
S&P or maybe the Dow a little bit, but it looks a lot like the Dow chart, I think. But you can see the LQD in relation to it, and if you look at investment grade corporate debt as far as rates versus high yield, you're seeing those spreads widen out right now.
And for
And
those following at home, that would be the IYG. We're putting all these up here as Brett talks about them.
yeah, so I mean, it's the last time that you saw this type of distinct divergence was maybe November 2007. That doesn't mean that the same thing's going to follow, but that kind of process is a hallmark process for identifying moments in the cycle, and when you start seeing confidence go toward just investment grade and up, and people start to throw off the middling and junk, that becomes a signal about the cycle. So these are taking into account those sorts of factors, as well as sector relationships. So it's a commentary about the cycle when you look at it in terms of the market as well as the economy. And of course it is. I mean, the sort of situation we're seeing right now, and as Gavin gave us a preface, we're going to kind of try to get into a little bit why some of these things are, but also that conversation is a little bit about why it may not mean the same thing as it did in 2007. The fact that people are having to prepare for an environment they don't understand and they aren't modeled to be able to cope with, and in fact an environment that may not actually come into existence. Everybody is really probably, and he's going to talk to this a little bit more in a minute, but probably pulling back on being able to make longer term and larger business investments based on not being able to predict what sort of regulatory structure you have for goods and money crossing borders.
Right. So next up, Brett, let's take a look. This was one that I know you mentioned to me because from now you've been following these a lot longer than I have, so I'm just following your lead. But the equity hedging you seem to get a little bit excited about when we were talking earlier. Now, this was one that was not yet at extreme levels, but from what I was listening to you on, it seems like it might hold. You were talking a little bit about that, the risk appetite having a little bit more inference, but this equity hedging might provide a little bit stronger direction. Would I be correct in that take?
Well, it's finally cracked up into that 60 area. I want to see it above 75 or 80 to really look at it as an extreme. But, once you get into this territory, you're looking at so this is like 6 different inputs that have to do with cash raising.
I'll read them all for
you can go ahead. Yeah, so 6 different. Go ahead.
Yeah, so 6 different inputs, as Brett was just saying. This has to deal with raising cash at equity funds, also buying put options, buying inverse exchange traded funds, buying inverse mutual funds, selling short futures contracts, and buying credit default swaps. So a pretty wide range of tools there for hedging.
Yeah, right. So and when you start to see the index tip up, it's typically an important sign of where things are headed. And I had been noticing a distinct lack of movement in this index over the last month or so. It started to move, but really kind of bridging above 60 is a little bit of a clue of things intensifying in that direction. And most likely that's large options trades, and it's being reflected in the Lobo ratio that we talked about earlier. But it's just another sign. It can definitely get more extreme than it is. And I would suspect that it's going to trace out something like the other one that I want to talk about, which is the VIX. And I made a comment on Friday and again this morning that kind of notes that there's a process of analyzing the VIX where I think that in my experience, there is, generally speaking, in a correction that is part of a bull market, even a severe correction, you will see the region around where you're getting close to the lows, you're getting close to the lows. If you see a distinct change in character in the VIX, it starts to move much more dramatically. And we really are not seeing the VIX act that way right now. I understand that it's at close to 20, but it's creeping up while the market makes much lower lows relative to where it was in early and mid-May. And that's a divergence. So there was much more insurance-seeking activity going on in early and mid-May than there is now. The market is going down, and there's less insurance seeking because the VIX is essentially a measure of the demand for catastrophe insurance in market terms. And when it doesn't spike, what it means is the market is going down on selling rather than insurance-seeking activity. And generally speaking, in my experience, if you have a large money manager who has a portfolio of stocks and you're in a correction, the stocks will be sold until you get down to a core level that want to be held, and then the activity from there goes to insurance seeking activity on that core portfolio. And so you see correction cycles have a kind of life cycle that is selling with the VIX low to selling with the VIX medium to selling sharper and more emotionally, and then the VIX spiking. And it's that VIX spike that tends to be the sign that you're in the latter stages of the very mature point of the correction. And right now, it's still just kind of creeping along. So there is possibly the case that this time is different, that this will be a different kind of correction, that, as I heard from someone else, that people have already done so much hedging that they don't need to do more hedging now, and that the market moving down is just a good opportunity. And that's possible. In my experience, there's very, very few examples where corrections don't follow that pattern. And usually when you're trending lower in a VIX that's really not spiking, it's not a great time to just be kind of scaling in long on things.
Okay, and just while we're talking here, Brett, we got NASDAQ sneaking back down towards its session lows here, trading at 69.78. You don't have anything on the futures right now, do you?
What do you mean?
Any shorts at all or anything? Are you short
No,
anything right now?
I got spiked out of my NASDAQ short.
Okay. And then the S&P, it's having a little bit more of an aggressive dive. So I guess real quick, Brett, we could kind of discuss this intraday dynamic where we've seen a couple of attempts by people to discuss different trades that could be through, and also Bullard on the monetary policy. And do you reading anything into the spike on the Bullard comments and the spike? This can be more of a technical level too, but it also corresponded with the UK trade deal that both times we've seen a little bit of an attempt to rally, that it's gotten rolled over here.
I mean, you got too many people sitting short. The headline comes out, people cover, and then when it doesn't really extend, they get back in their positions. And I think that you don't have real buying coming in on that. I mean, there's nothing there. So we'll talk about this probably a little bit more, but obviously the statement that we're going to have a big, awesome trade deal with the UK has just kind of is a statement that just flies so dramatically in the face of the tweets that did on Friday about Mexico, which was the day after we had a new NAFTA agreement. And then, there's suddenly the threat of 25% tweets or tariffs in a tweet.
Increased tweets.
But, it could be 25% more tweets too. Which, if each one of them is 25% tariffs, my goodness. But yeah, the idea that you've diluted the meaning of a trade deal, and then so that doesn't carry a lot of impact, I think, with the market right now. To just suggest that trade deals are on the way, I think that's something that has been trodden upon a little bit too much at this point. And then, of course, Bullard, I posted an hour before Bullard came out pointing out that Goldman Sachs is now looking for 2 rate cuts by the end of the year. Barclays is looking for, I think, 3 and 2 in September at once. And the Fed funds futures are now looking for 3 or 4 or 5 by next March.
The irony being on December 3rd, they were all looking for 3 rate hikes in 2019, which just kind of shows the power predictability.
Is that true?
On this, right? Yeah, I do remember that was right before.
That's amazing.
Yeah.
Yeah. Yeah.
So, so they basically had a 5 rate move swing in the last 6.5 months.
And just look at the people who kind of saw that coming and were shorting or were buying treasuries in November.
Yep.
I mean, that's been the trade of the year right there. Buying treasury futures in November has been whoever did that. Give yourself a round of applause. You are the person who won.
Yeah. No, I agree. So we'll get into these trade talks a little bit more here in a couple minutes. There was one more sentiment reader, Brett, that I thought was important for us to cover, and very timely as it came out this morning at 10 a.m., and that would be the ISM manufacturing number. Now, obviously, you never want to read too much into one report. You want to be on the lookout for trends, and certainly the trend's been heading lower. But there's a few items in there breaking down the different sectors that I thought was interesting and need to be understood in order to kind of understand where we could go in terms of swings both to the up and down side. And Brett, I'll just go through and you can give me your thoughts right off the top of your head on each sector as I discuss them. But
Okay.
When breaking down the ISM, number one, we already know that the overall trend is heading lower, and that's certainly cause for concern. It's still above the 50 level, of course, which is important, but continues to tread down there. Now, what we saw in it was the following was growing, and that's new orders, production, and employment all growing. Anything in there surprise you at all?
So say it again. Which ones were growing?
New orders, production, and employment.
Um, I would just say that I suppose that we're at this tipping point on the fence, and I mean it would be reading too much into it to try to define why that's happening and imagine the motivations of the respondents there. But I could imagine a universe in which we're staying with our plan until we see definite signs that things are deteriorating.
All right. Next, there's one of the reasons that I brought up a few weeks ago, and I know you've been hammering it home, is supplier deliveries slowing at a slower rate. So I guess they are contracting at a little slower rate, but backlog is contracting. And that for me, and I don't know if you agree with this, Brett, is a direct read into uncertainty around the trade environment moving forward.
It's a long, yeah. It highlights the long-term planning issue that we have begun to construct with this trade policy regimen.
So there, what we were talking about before, you're seeing that play out here in this survey. Then raw material inventory is growing, and customer inventory is too low. And now the first one, my inference would be, and I don't know if you agree with this, Brett, would be front end loading on the fear of tariffs. Would you agree with that?
It could just be that I mean, the two could be resolved just by the idea that there is a consistent amount of production of raw inputs and a reducing amount of consumption of them in terms of inventory building. That would account for both.
Right. And
But it could be also, yeah, it could be also that we're not sure that we're going to continue to be able to get such and such from such and such place, and so we're going to get a bunch of it stocked up.
right, we've seen plenty on the rare earth materials and things of that nature.
There you go.
So
Sure.
it could be front end loading on that ahead of any threats.
And now there's
But
Australia that's in the mix too. So there's a ton of natural resources coming from Australia.
Australia and Brazil as well too. I'd probably throw in that. That's a
Right.
pretty heavy
So we may be
commodity.
we may be storing up acorns ahead of the winter.
Exactly. And then this was the one that kind of caught me for a surprise, and I brought it up to you. Customer inventory is too low, and I think it's important to understand this dynamic, Brett. If you want to explain to people how that could factor in, because we've discussed a lot how a lot of the issues that we're facing are a little bit man-made as they try to dismantle 40-year trend that's been in place on the trade front. The customer inventory is too low. How would you see that playing out in the markets if all of a sudden we started getting a little bit better news on the trade front?
Well, I mean, without that last statement, I would just say you're subject to a situation if you're running a business where you don't understand necessarily what the rules of the game that you're playing are going to be a month or two from now. So you're not going to extend major capital investment, period, in that type of environment. You're going to stay as nimble and as flexible as you possibly can so that you can make the right choices depending on how the rules change, because the rules of the game for business, for the business economy, the rules of the game are in flux right now, and to a degree that we haven't seen. And when you throw in the antitrust stuff, and I mean, obviously, you're restructuring. So all of this trade stuff is about structuring of supply chains, and it's a big fixed cost investment to restructure your supply chain. Right? It's a one of the things that we can talk about with Mexico is if you've got a business established in Mexico where you're selling to U.S. consumers and you're using U.S. capital and you're having manufacturing in Mexico, typical arrangement. It's a major. It's not like you don't flip a switch and the next day your factory's in Ohio. It's a time-consuming major investment to restructure that supply chain, and you may need to do that, and you may not, and you're not sure now because of Friday. So you don't know what you're going to be doing. And I think that just the way that the fallout from the way that the China deal deteriorated and the rising kind of sense that, well, now everything's in play, I think that people are just unwilling to make major investments. And then there's a generalized uncertainty as far as the cycle is concerned. So it's just reduced ability to plan for 3-month, 6-month, 9-month timeframes with business investment. So I think that it's a move towards staying extremely flexible more than anything else.
Yeah, and it's not just the supply chain too. On the material side, certainly the auto sector has been hit hard by this. But all of a sudden, you get headlines from earlier from Senator Grassley talking about imposing taxes on money transfers between the two countries. So all of a sudden, it starts working into the financial system that all of a sudden comes under attack. And you know, we obviously the 2007 crisis really showed us how much interaction there is on the international front, just on the financial system. So
I
this
mean,
is
you
where
bring in counterparties then,
exactly. I mean, this
and now you got dominoes.
exactly. You got the dominoes here. So there's a lot of factors being worked in here that needs to be taken into consideration. But and we'll get into the trade rate a little bit more in depth right now. But I did find that customer inventories being too low was something of interest in terms of a potential V-shaped turnaround if we did start seeing some of the ice crack on this. And now the question is
That's the other huge factor, like that we as we talked about earlier. That's the sense that it's not completely impossible that this could all be one of those stories where terrible things happen to the main character, and then the last page of the book is the sound of an alarm going off, and they wake up and it was all a dream and everything's fine. That's kind of the feeling out there. I think with I doubt that that's the scenario we're living in, but you still can't completely discount it because it is down to a choice. It's down to a small number of people making a different choice.
It is, and I guess the risk for the markets is more along the lines of, do we get too far down the road where even that snapback, they're able to do that, or do we see the string slip through their hands, like pretending to dangle somebody from a building, and then all of a sudden you lose their hand and they slip off. That's
we've
do we hit that level, and that's the real concern
turtles
for the markets. Yeah,
it's the turtles, right? Did we get to a place in the cycle where we built up enough vulnerability with enough risk assumption that when we start to get that feedback loop going in the other direction, that it starts to that problems that weren't problems with a different level of confidence start to become big problems? Is it the case that if we slow things down enough, suddenly we find out, it's the Buffett line of when the tide goes out, who's not wearing a bathing suit? Like suddenly there's lots of naked people because in an environment where everybody had supreme confidence that tomorrow was going to be better than today, the debt levels were okay at certain companies. But then in an environment where the tide starts going out, it starts to create more problems. And could the lack of business investment spurred by the way that this narrative is being played out in terms of the protectionist agenda, is that going to create some little additional tangential feedback loops that start to expose the level of vulnerability that had maybe built up in the system over the course of the cycle, which is possible?
Okay. And with that, we're breaking 2 session lows here. Some more Bullard headlines crossing as well. And, he's making some pretty cautious comments around the trade narrative, saying that it's darkened and that a recent trip to Hong Kong has left him more pessimistic about a trade deal getting done. So the idea that Bullard wants to cut rates, it's not for all the good reasons. It's not to goose the markets, it's because he's afraid of what's out there. But Brett, I thought you put together a pretty nice piece on whatchamacallit on Friday, kind of detailing very eloquently why there was an issue behind these tariffs, and a lot of people were like, "Well, it's 5%. That's not that much." But there's a different story behind the tariffs that the Mexico story, I think, unearthed, that the China story had not necessarily done. China was more there's two global economic giants battling for supremacy here, and they're both kind of testing each other out with some tariffs. But the Mexico tariffs kind of changed the idea behind the tariffs and the usage of them. So you want to just kind of postulate your thesis from Friday that you were putting forward on why yields were getting hit so hard?
Yeah, I mean, I think that I think that it really is just the statement that there's more players involved in this situation than ones that we could possibly have control over if we were able to perfectly control the situation. We have to understand and interact with the motivations of other trading partners. And when you start to send a signal that this is now a process whereby at any moment a completely economically game-changing new policy can arise seemingly on a whim and seemingly without any system of checks and balances. That there's no oversight, there's no governance, there's no process. There's just a very small number of people. All they have to do is get on the same page, or maybe even one person who gets on the same page, and then suddenly the economic reality of something else is shifted. It's not a judgment. I'm not making a judgment of whether or not that action is correct. All I'm saying is the way the game theory plays out then is the rules are out the window. And when the rules go out the window, the game theory conundrum that emerges is people stop playing the game. It doesn't matter what's right or wrong. You're not going to get a trade deal with the EU, with China, with Japan, with anyone if the context is defined by something that appears from their perspective to be so up in the air, so casual, so whimsical with complete game-changing shifts in policy. Because what's the point of signing a deal? What's the point of Mexico and Canada getting together with the U.S. on a new NAFTA deal if the very next day there's a threat of 25% tariffs against Mexico? Right or wrong, in terms of their underlying causality, there's other strategies to get that type of thing done. When you use tariffs as your weapon, as your specific means of accomplishing policy, then you bring in economic game theory. And that takes people out of any type of negotiation. That's why you have these protectionist spirals that we've seen in history. That's why they have the impact they have. That's why people warn so much against this type of policy direction. It's not because your underlying mission is correct or not. It's just when you start to use that particular mode, you start to bring in this kind of process of everybody then being forced to collapse to what's called a Nash equilibrium of isolationism. And even if they don't want to. And I don't know if there's a way to avoid it at this point. You start to go around that curve. If people start to fix on that Nash equilibrium of isolationism, everybody has to start behaving the same way once one of the major players starts behaving that way. And
exactly.
Everything you've
seen that with Mexico too, kind of playing out because they've gone to tweeting with all their regulators. I don't know if you saw the one foreign minister that took a picture of himself at the airport going to talk with the president with a Huawei phone and a Huawei charging station sitting behind him.
And the other factor here, and this is going to be kind of a little bit of a stretch, but again, remember that it takes a lot of fixed cost investment and a lot of time to restructure a supply chain. And right now, and let's just kind of go on this adventure a little bit, because right now, according to basically every poll, Biden is polling ahead of Trump in a general election. Biden would have a very different take on Mexico. So if you're a big company, you've got your supply chain structured through Mexico, and there's a big time and financial fixed cost investment in restructuring it, what are you going to do if there's 25% tariffs? You can either wait a year and change, or you can make that investment and change your supply chain. If you would prefer to wait a year and change, because Biden may be suddenly in the White House and the tariffs are immediately dropped, then if you're going to prefer to wait, then you're just going to pass those costs on. Rather than the only blow to Mexico happens if these companies start to move out of Mexico. And that's a process. So the fact that the polls are tipping in the direction they are may incentivize companies to simply not be efficient with their decision making in terms of what would benefit the U.S. economy and be the least efficient possible, which means this would have the maximum impact. And if other people see it the same way. Now, you and I have talked about the China situation, and it seems like politically that's a bipartisan issue to crack down on China. So I don't know if that type of logic plays out in terms of how we deal with China. But it may play out in terms of everybody else on the map. And everybody else on the map may just go ahead and say, we're just going to play hardball with the White House for another 16, 17 months.
Right, particularly in Mexico, where they know that the border issue is not even on the Democrats' radar. If anything, it's on the flip side of that. So that would certainly be one area where where you would see a lot of kickback and maybe see that play out, trying to impose some pain from the Mexico side in order to win favor with the Democrats and get in. So that's one that they definitely wouldn't be able to get away with. And I'd even say the same for Europe as well. But there'll be a whole other slew of issues depending. I mean,
Well, so
we just don't, I think the biggest unknown for most of the foreign markets is they don't know if the Democrats got in, who would they be dealing with? Are you dealing with Sanders? Are you dealing with Biden? I mean, I think that does factor. A little bit of uncertainty kind of helps the Trump administration right now in terms of, the devil type thing.
yeah, I think that I mean if we can foray a little bit into that, I think that it comes down to where Trump is polling. The degree to which Trump seems vulnerable is the degree to which the Democrats are going to move left in the primaries, and
Yeah.
the degree to which he seems strong is the degree to which it will be Biden.
Yeah. I mean, Biden's definitely the front runner in most markets that you have here, but I think at this time in 2015, I don't even know if Trump was even on the radar for most people.
Yeah, it is. Yeah, it's a longer game than it feels.
So it's tough, but again, that plays out to those longer term orders that we were talking about earlier.
And this is germane to the analysis. It's not just political discussion, because this has to do with markets are considering these issues and how you believe that it's going to be a 25% tariff with Mexico?
Yeah.
Do you believe that there's going to be fallout with the EU and Japan and an escalation with India and Australia and whoever else? Because that's your kind of, that's your window into possible recession and bear market. And there's a lot of all of these factors that are going to essentially pave the way one way or the other. Again, this is this incredibly binary situation where we could possibly see a snapback to the other world, and we've got people not prepared for it at all. So you've got this enormous kind of binary outcome situation. We're sitting at the narrow end of a megaphone right now, probabilistically.
Right. So I think, the past 45 minutes here, Brett, we've kind of laid out why we've been bullish and what we're watching here. So, hopefully this discussion's providing, we haven't gotten to the point where we're providing as many trades outside of obviously shorting indices here, but hopefully this gives people a lot better understanding of why Brett and I have both been leaning on the markets to the short side, but also the understanding that why we do see the potential for a whip around in the proper context, but that I think both of us agree that that's getting heavier and heavier as we go along. But Brett, before we go, I think it's important for us to take a quick glance at what lies ahead and what we'll be looking for in some of these events moving forward in the markets, starting with Powell tomorrow morning. Is there anything that he could do that would maybe be a little bit of a game changer for you?
No. I mean,
Really
yeah,
not,
yes,
right?
yes, he could.
Unless he came out and flat out said that there would be a rate cut. That
If he sounded like he did in early December.
On the hawkish side, saying that everything's great and that he was
everything is fine, everything is wonderful. Inflation's definitely, we've got a transitory problem. We might need to raise rates pretty soon. That would be a game changer. Otherwise, no. That's not going to happen. I'm not predicting that.
Right? Yeah,
that would be the thing where, oh gosh, everything's turned on its head.
Right, because we already got the rate cut already priced in.
Yeah, I mean, we know what's coming here unless there's this really strange change.
So I would have to think, and real quick, we are seeing a little bounce in the S&P here as it tests that overnight high at 2732 we were discussing before. I'd like to see a little bit of a rally here because I think I'd be looking to fade that tomorrow.
I think you got to bust the 2725 orders.
Yeah. In order to get that some point. Now, I wonder if any of this would be a little bit of not hedging so much as covering some shorts in front of Powell tomorrow. And that was my point going to be with Powell. Like, if he did strike a really dovish tone and people were like, okay, the rate hike's on, Powell just all about said this.
Rate cut?
Or rate cut, I should say. I think that would be a nice shorting opportunity potentially.
Well, I think that the market is moving like it is, assuming that there will be a rate cut. So, yes. So, if there's just a knee-jerk reaction to Powell saying it,
exactly.
Then 5 minutes later, everybody goes, but we already knew that. And I was, so you're going to get some short covering, but you're not going to get in. Any new inputs of capital would already be flowing in.
Yeah.
Right? Any serious, strong-handed buying would already be there because, as of Friday, we had, two rate cuts priced in for the year.
Yeah. So, okay. So, then we got Beige Book. I guess it's pretty similar to what I would say for PAL as well,
Yeah.
in terms of commentary that we could expect. Certainly looking for a lot of caution around the trade wars and slowdown in some of the various industries around the trade war. ECB Draghi. He's expected to lay out the terms for the TLTROs, which is their lending program out there. I'm expecting him to be pretty generous. I'll be curious if he could get them as generous as the market would hope to see.
Yeah, right.
And then finally, the jobs number. Um, but say we get a weak jobs number, how do you think? I guess there's a lot in between now and then. Do you think that? Do you think the market reacts positively to that on the idea of a rate cut, or do you think that basically signals game on recessions coming?
It depends on how weak. I think that there's more likely to be holdouts that are positioned that this is all just essentially a storm of negotiating bluffs, which is possible, right? I mean, there isn't a lot of serious economic damage. There's just you can extrapolate from what we believe is happening in terms of the shape of the sort of market's version of space-time. The rules are changing, and so we would expect different phenomena to follow as the rules change. And I think that if we see a distinctly markedly bad jobs number, then people start to get a more concrete sense that what's already happened in terms of changing the rules is impacting decision making from people who are in charge of job creating. And that is going to start that process of a recursive feedback back into the system to reshape the way that the economic data is likely to come down the pipe. So I think that there's probably been people who are holdouts. I think probably if you have a bad number, it's going to be a selling situation, even though people are as hedged as they are. I think initially, at least, that I would probably short a bad number initially and then look to cover, and then maybe we kind of price in the idea that this has real economic impact in a quick, sharp, sudden move, and then maybe we've cleared things out enough to move into a more substantial bounce.
All right. So, Brett, I think we've said a lot here, and we'll be posting this shortly. But before we go, anything that you would like to point out or add to the discussion here?
Well, so I'd just like to summarize then. So from the sentiment and flow show perspective on the market right now, we have unquestionably a situation where people are braced for a recession and a bear market. And that's really important to understand that some of the greatest buying opportunities that you will get in a bull market, to contradict the tone of maybe everything I've said until now into the show, like it is still true. I'm going to admit to the fact that this type of situation, if it resolves well, is precisely the best type of buying opportunity. When the larger money being controlled in the market is clearly bracing for a recession. I think that that's happening now. I think that we've seen. I think that the types
in the customer orders number that we were talking about before that shows there could be a whip back in demand as things get settled as well, adding to that.
Yeah, and you've got Barclays coming out saying there's going to be 2 rate cuts in September. We're not that far off the zero lower bound. That kind of action is a cycle turning point. That doesn't happen as a proactive move. If that's the reality that we're in, Treasury's taken off to the upside, gold taken off to the upside, the Fed cutting 50 basis points in a single meeting after we store up, all-time record corporate debt, like that's something that's likely to be a dominoes falling, self-reinforcing feedback loop of risk aversion over the next several quarters, leading to at some point the cycles board saying, here's when the recession started, here's when it ended, and the market's had a bear market. Like the cyclicality happens. Cyclicality is a real conceptual object. And if we're there, people are braced against that. People are positioned for that. That's why you see the Lobo ratio spiking where it is. People are braced for that, and we've seen the hedging go across the board. So if this is a situation that suddenly starts to resolve itself with a trade deal with China, with, maybe a redefining of what we're really talking about with Mexico, and a kind of different energy to things, then this market could rocket higher. So we're at that kind of moment, and all I can say is the only thing that's not giving me the feeling of that type of thing is the VIX. But beyond that, all I can say is, even in light of all that, it seems like the structural rule changing that's going on, it's deserved hedging that's there.
Right.
It's a very real threat to, the narrative, as I said earlier, that has essentially defined this cycle is the mega cap tech sector and global free trade. And both of those pillars are being, dug up from the ground and chopped. And it's hard to understand if that's really what's happening here. It's hard to understand how we would pass through that process without a correction, genuine correction in the economy.
Yeah, I mean, it would be difficult to assume that we couldn't, given, I mean, the way I look at it is you have a trend line for the last 40 years, but not going parabolic, but certainly steady going higher. Now all of a sudden that's getting broken down, and you know, one would expect it to dip a lot faster than it took to grow. So it could certainly be a nasty cyclical downturn if we don't see things kind of straighten themselves out.
And let me add to that, because again, as I've discussed before, when the reason why I own gold right now is because we have a situation where we're normally, when you get to the end stages of an expansion period, a cycle, you have balanced budgets, or you start to see surpluses, because that's when tax revenues are best. That's when you have to use the least fiscal stimulus. And it's a very strange situation that we have right now, that we have a sort of collapsing fiscal situation during 2018, and we're starting to head toward trillion plus deficits in an expansion context. And so what that means is, if we were to move into a contraction, one would imagine, now I don't know, but there's modern monetary theory possibilities, who knows what will actually take place, but one would consider
again the uncertainty of 2020 there, right?
Yeah, I mean, do you run a $4 trillion deficit at that point? I don't know, but if you were to move into a recession already with $1 trillion deficits, you're going to spike those to $2 trillion, just based on the massive and sharp decline in tax revenues and the increased need for fiscal stimulus. And you're not going to be able to do enough fiscal stimulus to try to counteract what's happening in the contraction in the economy. So it's going to all fall on the Fed. And the Fed has already kind of moved toward, we're not so sure that negative interest rates are that interesting a tool, and quantitative easing has sort of run its course. And so what are we going to get? They're going to be the zero lower bound in theory very quickly, and it's this feeling of uncharted territory about how you would handle a recession under a situation where the fiscal balance sheet's blown up before the recession starts. So that's where I think gold is interesting. That's why I'm in it, is just because people kind of get the feeling of, I don't know how policymakers are going to deal with that kind of scenario, and we could have something like the idea of modern monetary theory, which other people could look at as just a much grander scale of just sort of printing money through something. And I could see that maybe even working out okay, but at least there's a phase where people go, oh my goodness, what's happening here? I need to own something like gold. So I don't know, I'm not a gold bug, by the way. I've traded gold a lot over the years, and primarily to the short side. And most of my big trades in gold have been to look for gold bugs getting excited about gold and to short gold. So just to understand that that's coming from me, that I own gold on that type of basis, because it actually, the pieces fit a little bit better right now. And I'm not saying we're headed towards some kind of crazy hyperinflation or something, not at all. But I am saying there's going to be people who are managing very large, like family offices managing $1 billion or $2 billion. There's lots of them out there. And they don't understand what the rules of money are going to be if we get into a situation like that, because the whole concept of monetary policy is really in play right now. And just not understanding what the boundaries are for reality in that kind of situation causes people to maybe want something like gold to go from 10% holding to a 25% holding. And if you get enough people doing that, that's where you get a really rather significant move.
Right. Okay. Perfect. Perfect summation right there. So, I mean, these are all things that we're going to continue to be watching, and hopefully, this gives you a little bit of insight into our thinking over here at the moment, and why we stand where we are, and why we're taking some of the trades that we are doing. But if there's any questions on any of this, feel free to write in a feedback. We'll be happy to answer them, and we'll be back here again next Monday to see how some things unwind, and of course being on the site throughout the course of the week to kind of give the play-by-play as things do unfold. All right,
Awesome.
Brett,
All right. Thank you very
you
much, Gav.
take care. We'll talk to you soon.
All right. Take care.
Okay, bye-bye.